Welcome back to the deep dive. So today we are really digging into something quite striking. We've got a collection of market analyses here, and they're all converging on this idea of a major year-end rally. They're even calling it a melt-up.
Yeah, melt up. And it's not just a mild prediction. We're talking potentially quite significant moves across, well, basically all risk-on assets.
Okay, so our mission today is to really break this down. We need to understand the core signals they're seeing, the big macro factors at play.
And to maybe pinpoint which assets look most poised for these big moves.
Exactly. The sources are talking about this unique mix of catalysts, this liquidity cocktail, suggesting something we haven't seen in, 7 or 8 years.
That's the term they're using, liquidity cocktail. And it's key because it means several things happening at once, all pushing the same way. It's an aggressive outlook, sure, but it seems grounded in some mechanical market realities.
And the foundation for this whole short-term bullish view seems to be volatility.
Correct. It really hinges on the VIX, the volatility index. That's the primary signal they're watching.
Okay, let's unpack that VIX relationship. Why the VIX specifically? I mean, why is that the highest precedence factor, maybe more so than the S&P's own chart?
Well, it really boils down to how certain large institutional funds operate, particularly these volatility control funds. It's quite mechanical.
Okay.
So when the VIX drops, it's signaling lower perceived risk, right?
Yeah.
Cheaper insurance premiums.
Right.
These funds, their models, directly tie their risk exposure to that implied volatility level.
So VIX goes down, and these funds, they have to reduce their hedges, their bearish bets.
Exactly that. They have to close out their put protection, those downside hedges. And as they do that, the same models force them to increase their long exposure, to buy the underlying index, like the S&P or the NAS 100.
So they become forced buyers, driving the market up just by de-risking.
Precisely. It creates this kind of self-fulfilling upward pressure almost regardless of the news flow. It can really accelerate a move.
Okay, so for this to kick off, we need a clear signal the VIX is actually heading lower. What are the technicals showing?
They've highlighted a specific pattern. It's called the inside 3-week failure.
Okay.
And it was apparently confirmed by what they called a Darth Vader candle.
The Darth Vader candle. Okay, love the name. But what does that actually signal on a chart? Is it just a big reversal candle?
It's pretty descriptive, yeah. It's typically a large, decisive candle that sweeps liquidity, often to the upside in the VIX's case, suggesting a final push that failed.
So it implies exhaustion. The buyers of protection are tapped out.
Essentially, yes.
Yeah.
It suggests the big players who needed protection got it, probably at a high price, and now that upward move in vol is stalling out, failing, the structure points to VIX deflating, maybe quite rapidly over the next few weeks, possibly down towards, say, 14 or even lower.
And the timing fits too, doesn't it? This lines up with typical market seasonality.
It lines up perfectly. You often see this pattern confirm the seasonal tendency. Historically, once you get past the main earnings rush and maybe the big FOMC meetings,
The market heads into November and December, which are usually strong months.
exactly, that's when the VIX tends to, head towards the gutter, as they say, leading into that potential Santa Claus rally period.
Okay, so the technicals are setting the stage with VIX potentially dropping. But let's pivot to the macro side. This liquidity cocktail suggests bigger forces.
Yeah.
What's the first big floodgate here?
Right, we've got two major ones opening up almost at the same time. The first is purely corporate-driven, the stock buyback window.
Which has been closed, right? Because
Yeah.
of earnings season blackouts. Companies couldn't buy their own stock.
Precisely. That mandatory blackout period ends typically in the first week of November.
And that explains why sometimes you see that jolt right at the start of the month.
It's a big part of it. But the key this year is the sheer amount of money involved, especially with index concentration.
Right, the whole weighting issue in the major indices.
It's staggering. Think about the NASDAQ. The top 10 companies make up something like 60% of the index's weight.
60%. Wow.
So take Apple, for instance. Huge revenues, around $394 billion forecast for FY24. But their buyback authorizations are often massive, sometimes exceeding $120 billion a year.
Wait, $100 billion or more just from Apple buying its own shares? That's enormous. It has to artificially support the price.
It absolutely does. It reduces the available shares, creates constant demand. It's a huge mechanical tailwind. And because Apple and others like it are so heavily weighted,
If just those top few companies rise, say 10%, because of their buybacks.
the whole NASDAQ index gets pulled up mathematically by maybe 6%, just from that activity alone, even if the smaller stocks aren't doing much.
Okay, that's a powerful corporate tailwind. What's the second big piece? The one involving the Fed.
That's the potential end of quantitative tightening, or QT.
Right. QT is where the Fed's been shrinking its balance sheet, effectively pulling money out of the system.
Exactly. It's been draining about $40 billion a month since May 2022, a constant headwind sucking liquidity out.
So just stopping that drain is significant. But does it imply more?
Well, the thinking is ending QT paves the way for the next step, which could eventually be quantitative easing, QE. That's a massive liquidity injection.
Ah, okay. So stopping the drain is step one, but the market starts pricing in potential future easing.
That seems to be the idea. If the Fed confirms QT is done, speculation about future QE could really take off. And having these things align, QT ending, buybacks surging, it's a combination, the sources say, we haven't really seen in maybe 7 or 8 years. It makes a long position almost necessary, they argue.
Okay, so if we're meant to be long risk assets, some might look at U.S. equities, especially tech, and say, haven't they already run a lot? Aren't they overextended? How do these analyses counter that?
They use cross-market comparisons, and interestingly, it suggests U.S. equities might actually be the laggards right now.
Laggards. Really? Compared to what?
Look at the Nasdaq Q versus, say, the Nikkei in Japan. The Nikkei's up something like 27% from its quarterly low, just phenomenal.
27%. Okay. And the NAS 100 over that same time.
Only up about 4.5%.
Wow, that's a huge difference.
Massive divergence. It suggests the U.S. markets, maybe tech especially, have been consolidating, absorbing that QT drain we talked about, and are now coiled for a catch-up move. The Nikkei looks like it's in that accelerating blow-off top phase. The idea is U.S. equities are just starting their acceleration.
Which puts the spotlight squarely on the big U.S. tech names, the Mag 7, to lead that catch-up. Which ones specifically look like high-conviction plays?
Well, within that group, there are a few that seem particularly coiled or lagging. First, Microsoft, MSFT, is showing that same inside 3-week failure pattern we saw in the VIX analysis, but inverted, suggesting it's ready to break out. The target mentioned is around $555, possibly triggered by earnings.
Okay, Microsoft.
Then there's Amazon, AMZN. The argument here is it's perhaps the most undervalued name in the Nasdaq Q Top 20, especially with their potential in AI robotics revolutionizing fulfillment. The target is pretty ambitious, $300 within the next, say, 3 to 4 months.
$300 for Amazon.
Okay.
And you mentioned laggards. Is there one that stands out as really behind the curve?
Definitely Meta. The divergence is quite stark. If you look at the Nasdaq Q ETF, QPQ, it's trading well above its high from February 2025, something like 14% above it.
Okay.
But Meta, it's basically sitting right at that same February high. It hasn't participated nearly as much in the recent index string.
So it's like stored potential energy, especially considering how Meta can move.
Exactly. Remember, since the 2022 lows, Meta returned something like 740%. The NAS 100 did about 150% in the same period. It can dramatically outperform when it gets going.
That lagging setup must be why they highlighted a specific trade.
Yes, there's a very high conviction option strategy mentioned. It involves using far out of the money calls, specifically the April 2026 strike 850 calls. The idea is to capture a potential 300% return if Meta really takes off in that expected January expansion phase. It's betting on a big catch-up move.
Interesting. Aggressive play. And quickly, what about Tesla, TSLA? Where does it fit?
Tesla's got this huge multi-year ascending triangle pattern forming, very powerful technically. And the near-term catalyst is that shareholder vote on November 6th about the XAI investment.
Right, which you could reframe it more as an AI company.
Precisely. If that passes, it really bolsters the AI narrative. The analysis was pretty clear. Preference is to be long Tesla versus something like the Russell 2000 index. Tesla just has much stronger fundamentals than many companies in the Russell.
Okay, so equities look primed, driven by this liquidity. Does that naturally spill over into assets like gold and Bitcoin, which are super sensitive to global liquidity?
Absolutely. That liquidity has to flow somewhere, and those are prime candidates. Gold first, it already looks like it's in a parabolic blow-off phase. The key metric here is the quarterly RSI, the relative strength index. It's up at 88.
88 is really high. Doesn't that scream overbought?
It is high, definitely. But context matters. If you look at historical bubbles, like the big run back in 2010, the RSI peaked closer to 95 or 96.
Ah, so while 88 is high, it might suggest there's still room to run before the absolute top.
That's the statistical argument, yes, that the top is likely not in yet.
So how do you trade that? What's the risk management? When is the rally definitively over?
The invalidation level is pretty clear, according to the sources. The top isn't confirmed, structurally, until gold actually takes out the low of the previous quarter. Until that happens, any pullback is viewed as a potential buying opportunity, not the start of a bear market.
Okay, treat pullbacks as dips to buy until the prior quarterly low breaks. Got it. Now, the ultimate leverage play on liquidity, Bitcoin. The relationship mentioned was like 10% up in NASDAQ Q equals 30% up in Bitcoin.
Something like that, yeah. It's seen as the highly levered bet on risk appetite and liquidity.
The short-term target mentioned is pretty eye-watering.
The gap fill target is $120,000. Yes, significant. But the long-term thesis is even bolder. We're talking potentially $1 million per coin within the next decade. So maybe 5 to 10 years out.
$1 million. Okay, that sounds incredibly speculative. What underpins that kind of forecast? Isn't there massive regulatory risk?
That's the million-dollar question, literally. The risk is acknowledged, of course.
Yeah.
But the bullish case relies on two key factors, mostly policy-related, actually. First is the ongoing institutional shift. You're seeing capital move away from proxies like MicroStrategy.
And into the newly approved spot ETFs like BlackRock's IBIT.
Exactly. That maturation, having regulated U.S. products, provides a level of confidence for big institutions that wasn't there before.
Okay, that's one factor. What's the second? You mentioned it was maybe less discussed?
Right. This one is fascinating. It centers on the potential role of CZ, the former CEO of Binance, following his recent pardon. The idea is that he might assist the U.S. administration in actually shaping the future crypto regulatory framework.
Really? How would that work?
Well, given his unique insight into global crypto flows and market structure, having him contribute could be seen as a way to create sensible, informed policy. The analysis views this as a potentially huge catalyst. It could provide the clarity and confidence needed for truly global institutional adoption orchestrated through these U.S. spot ETFs. It essentially legitimizes the asset class at the highest level.
Wow. Okay, that's certainly a different angle. If that played out, it would definitely add fuel to that long-term target.
For sure. And just quickly on a couple of others, Ethereum ETH is also expected to push for new all-time highs based on signals from its CME futures market structure. And Alibaba, BABA, is worth watching. Looks like a potential long opportunity if it pulls back to fill a gap around $157 before its earnings.
Okay, so let's wrap this up. The key takeaways from this deep dive. A strong technical signal from the VIX, suggesting lower volatility ahead.
The end of QT potentially opening the macro liquidity floodgates.
The huge corporate buyback window reopening, providing mechanical demand.
Has a significant catch-up potential seen in lagging NASDAQ giants like Meta and Amazon.
The overall picture painted is one poised for, well, blow-off tops across pretty much all risk-on assets.
A very bullish consensus from these sources.
So given this cocktail of factors, the VIX signal, the buybacks, the QT shift, something we haven't seen aligned like this in years, let's leave you with something to think about. It connects the macro to specific risk. If, hypothetically, the central banks fumble the end of QT, if that macro floodgate doesn't open as expected, which of those high-conviction plays we discussed, Meta or Bitcoin, carries the greater risk of turning into the ultimate bull trap? Which one is more vulnerable if that key macro driver fails? We'll let you chew on that one. Thanks for joining us on the Deep Dive.